I think we might see 40 this year. Of course, that's barring a black swan hitting a black swan where we could go crazy. But I do think that we're going to have a hard time getting over the 33 high that we saw last year. Once we do that, then we'll probably continue higher. I did say we would consolidate, and we kind of, what they do say in the commodities business, consolidate the gains. We've already seen both gold and silver up roughly 30% year over year last year. And so it's going to take a while to digest that kind of a move. And once we do, then they'll either move up or down, and it's probably going to move up. And it could go soon, it could go not soon. I'm thinking it's going to go between a big trading range, both gold and silver, in a trading range, which they both have been in for some time. I think that will continue for a few. The only caveat I have to that is there's a real stress going on in the exchange for physicals market, the ETF market, where you can exchange a piece of paper and get physical metal. And with the tariffs, that's throwing a wrench into the gears as well, because the silver users that need the product for industrial reasons are worried about a tariff. So now they're shipping silver here, there, and everywhere before a possible tariff goes in play, because if there's a tariff added on the silver, obviously that's going to increase the price. So there's a bit of a scramble going on in the silver market right now, and it looks on paper as if we could be in a situation that could go into silver. I'll say it on your show. I mean, I'm saying it's possible, but it is something to watch, because silver can defeat the best. I mean, I've been in this market too long, but it can surprise me, and I know what to look for more than the average person. Not perfectly, but I certainly have got more experience. And with all that said, I wouldn't be shocked if all of a sudden we are at 33, by March 1st, because there's problems getting physical in the silver market. What's ironic is I'm differentiating the silver market, which is the commercial bar 1,000 ounce bar market. That's the silver market, versus the retail market, which is your silver rounds, silver government minted coins, your kilo bars, and your 100-ounce bars. That market's dead, at least in North America. No one is buying silver in the retail market. In fact, the sells are greater than the buys. Talk about irony. The basic silver stacker out there is disgusted, worn out, tired, doesn't want to hear the words, got enough, I want to sell some, I'm waiting for a pop so I can get rid of some. And yet on the silver industrial / big buyers, which buy 1,000-ounce bars for investment, that market's pretty. And I'll own this, because I was the one actually way back when the silver market did really well from the year roughly 2000 and 2011. And I said, gold will preserve your wealth, but silver could, not would, but could make you wealth, meaning that silver will outperform gold. And it did during those years, but it hasn't since. In fact, it's really lagged gold based on the gold-silver ratio.
The silver market has been moving in a way that many did not anticipate. And while we have seen price consolidations, we must understand that the underlying fundamentals remain as strong as ever. I believe we might see silver hit $40 this year, barring any unexpected black swan events, but getting past the 33 high we saw last year will be a challenge. However, once we break that resistance, silver will likely continue to climb higher. We've already seen a strong performance over the past year, with both gold and silver up roughly 30% year over year. These types of gains take time to digest, and the market often consolidates before making the next move. I anticipate both metals remaining within a trading range for some time, though it is important to recognize that the broader market forces could accelerate the next breakout. One of the critical factors influencing silver right now is the growing concern over exchange for physical EFP markets and the impact of tariffs. The ETF market, which allows traders to exchange paper silver for physical metal, is under stress. This is primarily due to industrial users scrambling to secure silver supplies before potential tariffs are imposed. If tariffs are placed on imported silver, it will drive prices up significantly, forcing industrial buyers to front-load their purchases. This added pressure on an already tight market is a factor that could push silver into breakout territory sooner rather than later. We've already seen silver shipments being rerouted and shuffled globally, all in anticipation of regulatory changes that could dramatically increase costs for buyers. At the same time, there is a sharp divergence between the commercial silver market and the retail market. The commercial market, which deals in 1,000-ounce silver bars primarily used for industrial and institutional investment purposes, remains robust. Demand is strong, and concerns about supply shortages are growing. On the other hand, the retail silver market, which includes coins, rounds, kilobars, and 100-ounce bars, has slowed significantly, at least in North America. Retail investors, particularly silver stackers, seem exhausted. Many are either waiting for a price surge to sell or have lost interest altogether after years of frustration with silver's lagging performance. The irony is that while retail demand wanes, industrial demand is growing, setting the stage for a potential squeeze in available supply. This divergence raises a critical question. What happens when industrial users realize that silver shortages are no longer just speculation, but a reality? If a major electronics manufacturer like Apple suddenly finds itself unable to secure the silver needed for its iPhones, we could see a significant shift in market sentiment. Suppose a logistics department reports to Apple executives that their metal supplier has delayed delivery for 3 weeks due to a supply crunch. In that case, Apple and other manufacturers may panic and start hoarding silver. If word gets out that major corporations are scrambling for silver, it could trigger a chain reaction, leading both institutional and retail investors to rush in. This kind of panic buying could send silver prices skyrocketing in a short period. Another critical factor to consider is the gold-to-silver ratio, which currently sits around 85-1. Historically, when silver truly outperforms gold, this ratio narrows significantly. During the bull market from 2000 to 2011, silver outperformed gold dramatically, driving the ratio down to around 33-1 at its peak. If silver were to return to even half of that previous strength, we could see prices moving significantly higher. While gold is essential for wealth preservation, silver has always been the metal that can make outsized gains when the right conditions align. However, those conditions, widespread supply concerns, institutional accumulation, and inflation hedging, must all come together for silver to move into the next phase of its bull market. However, the fundamental argument for silver remains unchanged. It is a critical industrial metal with growing demand in green energy, solar technology, and electronics. No matter how much speculative money flows into crypto, the physical need for silver will continue to rise. Looking at where we are today, the silver market is teetering on the edge of something big. The setup is there for a potential squeeze, whether it's driven by tariffs, supply chain disruptions, or institutional demand. Something is going to force a change in this market. When that moment comes, we could see silver making moves that will shock those who have written it off. It's a waiting game, but those who understand silver's long-term value know that patience often pays off handsomely.
You know, when I was out there speaking on silver worldwide back in those years, silver went from, the $5 level all the way back up to 50 temporarily or close to it. And the gold-silver ratio got down to 33-1. Now the gold-silver ratio is like 85. Silver at, round numbers 30 and gold at 2,700. So if I had to take that statement back, which I can't, I'd say that gold preserves your wealth and so does silver. And that's about all it's done. And the only way I could see it really outperforming silver in the near future is a panic buy into silver, because there's a perception we're running out. So these deficits continue. One industry like Apple Computer doesn't have enough for the iPhone, and all of a sudden they go to their logistics department and they say, hey, order us, however many tons of silver we need for the next 3 months. And they say, hey, we just got a call from whatever metals dealer they're using. They don't have it. They can't get it to us for 3 weeks. So now Apple has to put their iPhone on hold. I'm just making up but something like that would take place. You might, if that got sniffed out and other industrial users knew that, they might go ahead and buy more than normal. And then if that caught on to the retail market or the investment community, institutional and retail, then you could see some panic buying. But I think that cryptocurrency world has taken over the silver world. What I mean by that, if you look at one of my favorite books back here, Silver, the Restless Metal, all the data through about 1960 shows if you have high inflation, silver. And I believe that. And it was by historical standard. But now, if we have a hyperinflation or a high inflation, it's probably the crypto.
The financial system is at a tipping point. And 2025 will likely be the year when everything begins to unravel. The excessive debt, government mismanagement, and the reckless monetary policies of central banks will accelerate the decline of fiat currencies, particularly the US dollar, euro, pound, and yen. This collapse will drive a monetary reset, forcing investors and institutions alike to seek safe havens in gold and silver. The historical trend has always been the same. When trust in fiat erodes, gold becomes money again. This time will be no different, but the collapse will be more severe than anything we've seen before. Let's talk about government debt, which is a ticking time bomb. The Western economies, US, UK, EU, and Japan, have built their financial system on an unsustainable foundation of debt. The US national debt is already over $36 trillion and rising rapidly. The Congressional Budget Office projects that interest payments alone will exceed $1.5 trillion per year by 2030. This is unsustainable and is the primary reason why the Federal Reserve and other central banks will have no choice but to print money aggressively to keep the system from imploding. Now let's consider the bond market, historically the most stable and risk-free investment vehicle. What happens when bondholders realize that their real yield is negative? The illusion of stability will shatter. The US 10-year Treasury currently yields around 4.5%, but if inflation is truly running at 7 to 10% per year, that means bondholders are losing purchasing power every year. This isn't speculation, it's simple arithmetic. If central banks continue raising rates to fight inflation, they risk triggering a financial meltdown, where banks, pension funds, and corporate borrowers start defaulting en masse. If they lower rates, they debase the currency, leading to runaway inflation. There is no way out. It's a game of musical chairs, and when the music stops, only gold and silver will be standing. For centuries, gold has been money, and silver has been its close companion. Central banks know this, which is why they have been on a gold-buying spree. In 2022 and 2023, central banks purchased more gold than in any year since records began. China, Russia, India, Turkey, and even Saudi Arabia have been aggressively accumulating gold while simultaneously dumping US treasuries. These nations understand that the global monetary system is shifting, and they want to be prepared. But here's the real question. Why are Western investors not following suit? The answer is simple. Financial media and Wall Street have convinced investors that stocks, bonds, and even cryptocurrencies are better alternatives. Yet history tells a different story. When financial systems collapse, gold and silver are the last assets standing. If you wait until the crisis is in full force, it will be too late. Gold will already be unobtainable, and silver will skyrocket. Even more important is the gold-silver ratio, which currently sits at 80 to 85 to 1. This means that silver is historically cheap compared to gold. In past monetary resets, silver's price tends to rise twice as fast as gold as investors, and industrial users scramble to secure supply. The window of opportunity is closing, and those who recognize it now will be in an enviable position when the system resets. The rise of BRICS nations, Brazil, Russia, India, China, South Africa, and now including Saudi Arabia, UAE, Egypt, and others, is one of the most important geopolitical and financial shifts of our time. These nations are actively de-dollarizing their economies, meaning they are reducing their dependence on the US dollar for international trade. This is catastrophic for the dollar's dominance as the world's reserve currency. China and Russia have already made it clear that they will settle trade in gold-backed mechanisms, yuan and rubles. The BRICS bloc has been discussing a gold-backed trade settlement system, which once implemented will reduce global demand for US dollars significantly. When this happens, trillions of offshore dollars will flood back into the US economy, triggering a wave of hyperinflation. We are already seeing signs of this with Saudi Arabia's recent agreements to trade oil in Chinese yuan instead of dollars. If OPEC nations start pricing oil in non-dollar terms, the petrodollar system that has propped up US financial dominance for decades will collapse. This would mean that dollars held by foreign governments and corporations would be dumped into the market, further devaluing the currency. The Federal Reserve's only option at that point will be to attempt a monetary reset, which will likely involve a gold-backed digital currency, CBDC. But let's be clear, central bank digital currencies, CBDCs, are about control, not freedom. They will allow governments to track and control every financial transaction. This is why owning physical gold and silver is the only way to escape financial repression. There is growing speculation that what we are witnessing is a deliberate, controlled demolition of the global financial system. Governments and central banks know they cannot pay their debts and they cannot control inflation. The only solution is to inflate away the debt and reset the system under new rules. But what will those rules be? Will we return to a gold-backed monetary system? Some experts believe that gold will be revalued to $10,000 or even $50,000 per ounce to absorb the excess debt and provide a stable monetary base. Others speculate that a global digital currency pegged to gold or a basket of commodities will emerge. Either way, gold and silver will play a central role in the new system. This is why governments and central banks are accumulating gold, even as they publicly dismiss its importance. They understand that when the current fiat system collapses, gold will be the anchor of the new financial order. While gold gets the headlines, silver could be the true winner in this monetary crisis. Silver is not only a monetary metal, but also an industrial metal, crucial for solar panels, electronics, and the upcoming green energy revolution. As governments push for more electric vehicles, solar power, and 5G technology, silver demand will explode. However, the supply of silver is rapidly shrinking. Silver mines are depleting, and production is struggling to keep up with demand. More than 60% of silver supply comes as a byproduct of other mining operations, meaning it cannot be easily ramped up like gold mining. This is why, when the financial system resets, silver will experience the biggest price surge in history. Investors who buy silver now are positioning themselves for a historic wealth transfer. Silver's gold-silver ratio is at extreme levels, meaning that if gold rises to $5,000 per ounce, silver could easily go to $200 to $300 per ounce or more. We are witnessing a once-in-a-century shift in the global financial system. The collapse of fiat currencies, the rise of BRICS gold-backed trade, and the end of the petrodollar system all point to gold and silver becoming the world's dominant stores of value once again. Investors who recognize this now have a rare opportunity to protect their wealth before the crisis fully unfolds. The signs are clear. Governments, central banks, and the elite are all buying gold. What does that tell you? They know what's coming. The biggest wealth transfers in history happen during monetary resets. Those who own gold and silver will emerge as the new financial elite, while those holding fiat currency, bonds, and overvalued stocks will be left in financial ruin. The time to act is now. Gold and silver are not investments. They are real money. History has proven this time and time again. Don't wait until it's too late. Be ahead of the curve. Accumulate physical gold and silver now and secure your financial future.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.